Cella again, Managing Principal of the KeyArx Group, and today we have Andy Hanlon from Hanlon Investments, and I'm so excited to have him talk about his strategy. We've been working with Hanlon for a number of years and with our top clients, and as Andy knows, we deal with a lot of professionals, doctors, attorneys, business owners, and the market has been through the roof, Andy, and we're not so much concerned, but what I've been wanting to communicate with people is having a defensive strategy. Most of our clients have amassed their wealth and they don't want to lose it. We don't have time for a big negative 20, 30% downturn and time to catch up for retirement. So I'm so glad you came in today. No better person than you to describe the strategies and the techniques that Hanlon does. But if you would, could you talk about the management and how the things you've put into place, how it helps go to cash when the timing is there, and just expand on your strategies from Hanlon.
Sure. Thanks, Paul. Hanlon Investment Management started out as a tactical manager. Sean, who's an engineer, Stevens Institute guy, he developed an algorithm that not only determined the strategic allocation, which funds you should be in, which ETFs you should be in, but also a tactical element overlaying that tells us every day, based on a number of metrics on the stock and the bond side, they're all technical and quantitative in nature, whether we should move some of that money to cash. So we started out really as a pure tactical manager that could go 100% to cash. In 2008, we spent 11 months and 2 days in cash.
And that's where we met with Andy in 2008.
Yeah.
So that was amazing.
Yeah, that was very popular. So and here's the thing about avoiding losses. When we talked about this earlier, in 2009 we made 30% on a lot of our portfolios, but we made 30% on 100% of the money. A lot of people made 30% in 2009 after losing 36% in 2008.
Yep.
And that's negative compounding. We could talk about that all day long. That's not good investing, especially for people that have already won, like you described, your high net clients. So we started out as this tactical guy, and this graph is very instructive, Paul, because it's the Dow Jones Industrial Average going back to 1897 up to pretty current. And so it shows that there are long periods of time, 1906 to 1924, where the Dow Jones didn't make a penny. From 29 to 54, didn't make a penny. 66 to 82, we all know 2000, 2010, we lived it. And so I'm not saying that's going to happen again. I am saying that Wall Street likes to tout that the Dow made 9.6% a year. This includes dividends. It made 6 and change, and then it was almost 3% in dividends. Yeah, and if you had 130 years, that's a decent metric, but we don't have any clients that have 130 years, right? So what we're saying is it would be nice to have a mechanism to avoid a big loss. If you were able to avoid a couple of big drops, not only would you save money, but your investment experience would be better. Yep. And it's that investment experience where emotion comes in, when we have some crazy thing happen and it pulls it down, where people do things that hurt themselves.
So could you talk about the mechanism? And my idea for my clients is I want to introduce Hanlon, that not for all of their money, but as a barometer for a piece of their asset. I believe everybody should have Hanlon a piece in their investment. Yeah. So can you talk about that algorithm or talk about how you do that?
Sure. First of all, our motto is we don't want to manage all your money, just the money you care about. so that's a perfect segue. So yes, we think it's a great combination. And what it does is, because we go to cash, we can just, we can go to cash in 3 minutes. We sell it out. We batch trade and sell out the ETFs that we're in and move it to money market funds. So it's just cash. And as I mentioned in 2008 as an example, we sat in money market funds for 11 months and 2 days. So each year we can sell out, even last year, fourth quarter, we were out 25%, then we were out 50%, stock and bonds. Then we were back in earlier in the year. And so we're actively managing. It's very active management. People throw tactical around a lot now. For us, tactical is the ability to go to cash. It's not just rearranging the
And how many people really do it, and how many people have the mechanisms to do it?
Not many, because a lot of people adopted tactical as a term after 2008 so they could catch the wave.
Right.
But they're really super strategic. So we love what you just described. Hanlon is not a replacement, it's a complement, right? When you add Hanlon to 25, 35, 40% of the portfolio, our other partners I pointed out, BlackRock, Wilshire, those all become stronger. because now you're more comfortable having that piece that can get more money because you've reduced so much over here. And you coming through the door that you came through in benefits and protection, asset protection, this is very consistent with who you are and what KeyArx does. And it brings that consistency over to the investment philosophy, which is so important because this is where their liquid money is.
Now, let me ask you one last question. Would you be willing to meet with some clients of ours and do a talk from time to time?
That's what we do.
Okay.
You know, and I think that's the best forum only because it's different. You know, when I first started, I moved my money to Sean in the early 2000s. My brother Sean, who owns the firm, our president and CEO. And the first time you go to cash is weird. Like I've always been invested up until that. And then you don't lose a penny.
Yeah, and that's got to feel good. Right?
Yeah, I mean, oh, the market went up. Yeah, but I didn't lose anything. You know, so I can get in now and still have all my money. And so that philosophy, you know, obviously we've expanded it to include the other partners. And, you know, for a client base like yours, I would welcome those opportunities because I think your clients have already won.
Yeah. Well, one last question I have for you is, you know, the market is just tearing it up right now. What would you do? You have an outlook, a brief outlook of what you might suggest going forward? And people are, you know, looking for yield right now. I know bonds are yields 1.8 or so thereabouts. Do you have any, you know, wrapping up suggestions?
Yeah, I mean, for the most part, we grew up in an environment where the 60-40 dominated, 60 stock, 40 bond. The 40 bond is gone. That 1.8% is the 10-year Treasury yield. So you're not going to make any money on the bond side, and you have tremendous risk because if rates go up, you're going to lose money.
Right.
And that wasn't the intent. That 40 was supposed to be the ballast. So now the tactical is your ballast. If your tactical is replacing that bond piece, then you can still keep the 60 and still be somewhat protected. Obviously, we get a little more dynamic than that, but in a general sense, what we're trying to do is get that ballast to be a ballast again. Because right now, bonds offer nothing and are more risky than they've ever been. A passive bond investment is a dangerous investment in some cases. We were talking about lending rates earlier. You know, where are they going? Are they going down further? You're gonna buy a bond to get capital appreciation if the 10-year goes from 1.8 to 1.2?
Right.
That's insane.
There's nothing.
There's nothing there. The risk outweighs the reward, especially for a component of your investment that was supposed to be your protection.
Right.
So, you know, we got dynamic to provide other solutions to replace that. And we don't envision that changing, certainly not this year. We don't think rates are spiking, you know, we just don't think there's gonna be too much variability. Things are good right now. We are fully invested, but it's an election year. We expect hiccups, and I wouldn't be surprised to see us move to cash on the stock side with some of the money or all the money at some point, depending on a headline.
Just depending on what happens.
Yeah.
Well, Andy, thank you.
Thank you, Paul. Appreciate the opportunity.
And again, Andy Hanlon from Hanlon Investments, and we'll be in touch soon.